as usual, prices are going up. Your dollar doesn't stretch like it used to. And for retirees, that's just not frustrating, it's outright dangerous. When you're no longer earning a paycheck, rising costs can eat away at your purchasing power each and every day. That's why investing during inflation requires a smarter approach. In this video, we'll explain how inflation impacts retirement income and how to build a portfolio that helps protect what you've worked so hard to earn. Inflation erodes the value of money over time. We understand that. A dollar today won't buy the same amount of goods and services tomorrow. Remember what a Coke cost when we were 10 years old? Certainly not the same price today. If you're retired or nearing retirement, you're probably going to be taking money from a fixed pool of assets. So when inflation spikes, your ability to maintain your lifestyle can take a serious hit. Healthcare costs, food, travel, almost everything becomes more expensive. But here's the key. Your investment strategy can either fight inflation or fall behind it. So there are typical common blind spots that most people think about, right? Like we talked about, there's healthcare, and that's growing crazy expensive, 5-6% every single year. But the one that brings up the most concern and the most attention, at least from our perspective, when we're sitting down and talking with our clients about it, is the fact that we think our kids are grown and out of the house, and so we no longer have to actually pay for them. But that is so far from the truth. As we age, we come to understand that our kids are always our kids and they always cost us money. And the cost of our children today is even higher than it was before. And to help them through their working years and help them raise their families, it's costing us more and more money. And it's at an inflated rate of return, right? The fact is that what it cost us to raise our children is completely different than what's costing our children to raise theirs. And to compound it even worse, when we're passing away and we're thinking about what our legacy is going to look like, we're thinking in our mind's eye that we're going to leave them $100,000 or $500,000 or $1 million. And I know it's a cliche, but $1 million is not what it used to be. So what do you want to avoid? Well, one of the biggest mistakes most retirees make is going too conservative too early. When people see volatility or rising prices, their instinct is to pull back, to be protective, to be defensive, moving everything into cash or fixed income. But here's the reality. Those assets often do not keep up with inflation over time. And the fact is that if you have a well drawn out plan, a well developed plan, and a strategy, you don't care about inflation because you have a bucket of money that is going to take care of it. And when you put all your money in safe buckets of money, what you're really doing is saving money and running out of money slowly. So what you should consider also is that equities have historically outpaced inflation over the long term. As a matter of fact, equities are up in the market 80% of that time. Now that doesn't mean you should put all your money in the stock market. That would be silly. But stock and growth-oriented investments still play a significant role in your financial future. And we also need to think of beyond traditional asset classes. Dividend-paying stocks are important. Tips, real estate, limited partnerships, structured notes, and even certain types of annuities can help maintain buying power over time based upon your overall plan. And don't overlook withdrawals. Remember, sequence of returns matters. A well-managed withdrawal strategy is just as important as what you're actually invested in. As you're thinking about our conversation today, and you're thinking to yourself, what can I do to prepare myself for inflation over the next decade or so? Obviously, the starting point is always to have a well-developed plan, so that would be a significant part. But you can also go back and look at your own portfolio and your own expenses and look at what part of this portfolio is going to actually address the inflation that we should expect. 2, 3, 4% is certainly reasonable that you should be protecting against. And you need to have a strategy that says that these specific assets, this part of my stock portfolio, this part of my fixed income portfolio is going to keep pace or exceed inflation during my retirement years. There's nothing worse than going broke or having to take a pay cut, so don't put yourself in that position. Inflation may not be in your control, but your strategy is. Do you want to stress test your current retirement income plan against rising costs? Do you want to make sure that you're never going to run out of money? Then download our free Savvy Investor Retirement Summary or schedule a discovery call with our team to learn more. See the button below? Click on it.